Hello everyone, I'm Sherry Borshoff with Bastion Business and Tax Services. We help business owners and investors protect, organize, and strategically grow their financial fortress through proactive tax planning and financial strategy. Today we're discussing one of the most misunderstood real estate investment strategies available, the Delaware Statutory Trust. If you've ever sold investment property, considered a 1031 exchange, or wondered how wealthy investors continue growing real estate portfolios without managing properties themselves, this video is for you. What is a Delaware Statutory Trust? Let's start with what it is. A Delaware Statutory Trust, commonly called a DST, is a legal entity that allows multiple investors to own fractional interests in large real estate properties. Think of it this way. Instead of owning 100% of a duplex apartment building or commercial property by yourself, you own a percentage of each larger property alongside other investors. That property could be apartment complexes, medical office buildings, industrial warehouses, self-storage facilities, distribution centers, retail developments. You get the picture. The property is professionally managed by a sponsor company, meaning investors receive the benefits of ownership without actively managing the real estate. What a DST is not. Before we go any further, let's clear up a common misconception. A Delaware Statutory Trust is not a family trust, a revocable living trust, an estate planning trust, a way to hide assets, a tax shelter. A DST is simply a legal structure used to own investment real estate. The tax benefits come from how it can be used in conjunction with a 1031 exchange. Why they were created, historically, many investors faced a challenge. Imagine you own a rental property worth $1 million. You want to sell it. You don't want to pay capital gains taxes. You also don't want to manage another property. The IRS requires that your 1031 exchange proceeds be invested into another qualifying investment property. But what if you don't want another property to manage? That's where a DST enters the picture. The IRS recognized Delaware Statutory Trust interests as qualifying replacement property for a 1031 exchange. This gave investors another option. So let me tell you how a DST works. Suppose you sell a rental property for $800,000. Rather than purchasing another building yourself, you complete a 1031 exchange and invest the proceeds into a DST. That DST might own a $50 million apartment complex, a $100 million industrial facility, a medical office portfolio. Your ownership becomes proportional to your investment amount. You receive your share of rental income, property appreciation, future sales proceeds. Meanwhile, professional managers are handling the leasing, the maintenance, the repairs, the tenant relations, and property operations. There are no more late night phone calls about broken water heaters. Why investors use DSTs? There are several reasons investors are attracted to this strategy. One, it's passive income. This is probably the biggest reason. Many landlords eventually reach a point where they want real estate income without active management responsibilities. DSTs can provide that transition. A 1031 exchange eligibility, DSTs qualify as a replacement property for 1031 exchanges. This allows investors to defer capital gains taxes while remaining invested in real estate. It also allows for diversification. Suppose you sell one rental property, instead of buying one replacement property, you may be able to spread your investment among multiple DST offerings. This can diversify geography, property types, tenant concentrations, rather than having all of your eggs in one basket. Access to institutional real estate is also another benefit. Most individual investors cannot buy a $75 million apartment complex on their own. So DSTs provide an access to larger professionally managed properties that would otherwise be out of reach. It's also a good retirement planning vehicle. Many investors use DSTs as part of a retirement strategy. They want income, simplicity, less management stress while remaining invested in real estate. Now here are some of the risks. Now let's discuss what sales brochures don't always emphasize. Every investment carries risks. DSTs are no exception. You have limited control. Once you invest, you are generally a passive owner. You cannot typically choose tenants, refinance any properties, direct operations, make management decisions. Those decisions belong to the sponsor. You have limited liquidity. DST interests are not traded like stocks. If you need your money back quickly, selling your interest may be difficult. This is generally considered a long-term investment. Market risk. Real estate values can decline. Occupancy rates can fall. Economic conditions can change. A DST is still a real estate investment. Sponsor risk is another factor. Quality of management matters. A well-managed property can perform very differently than a poorly managed one. This is why due diligence is critical. Who should consider a DST? A DST may be worth exploring if you're selling investment property. Need a 1031 exchange solution, want passive income, are tired of being a landlord, you want diversification, need help meeting the 45-day identification deadline, are planning for retirement. Who should probably avoid a DST? A DST may not be the best fit if you want complete control over your investments. If you need quick access to your money, it's not a good fit. Prefer actively managing properties, it's not a good fit. Are uncomfortable with long-term commitments, do not fully understand the investment. The most important thing to remember, a Delaware Statutory Trust is not primarily a tax strategy, it's an investment strategy. The 1031 exchange tax benefits are simply one component of the overall decision. Far too many investors focus on tax deferral and fail to evaluate whether the underlying investment itself makes sense. Always remember, good tax planning should support a good investment. It should never replace one. The Delaware Statutory Trust can be a powerful tool for investors looking to defer taxes, simplify their ownership, and remain invested in real estate. For the right investor, it can provide that passive income they're looking for. It can allow for diversification, relief from real estate management, and you don't want to get into doing it for the wrong decisions. That's why proper planning matters before entering a DST. Make sure you consult with your tax advisor, your financial advisor, your attorney, your qualified intermediary, and fully understand both the opportunities and the risks. If you found this video helpful, be sure to like and subscribe and share it with other investors who may be considering a 1031 exchange. And if you'd like help evaluating whether a DST fits into your overall tax and investment strategy, visit us at Bastion Business and Tax Services. The website address is in the links below. Here we help businesses build a fortress through proactive planning and strategic tax advice. I'm Sherry Borshoff, and I'll see you in the next video.